Good evening, everyone. Time for another silver update. This is the daily chart of the Euro Japanese yen. As you can see, the action in the Japanese yen continues. The Japanese have determined that they are intent upon destroying their currency. You can see that the US dollar Japanese yen as well. We're just rising in a straight line. As I pointed out in a video a while back, that this thing kind of smacks of the Plaza Accord. Of course, the Plaza Accord was a public meeting where they publicly met and decided to devalue the US dollar, and it was announced. This obviously hasn't been announced except for the election of Abe, but you can see here that if you remember the dramatic move in Fukushima, uh, now that just seems like just a little tiny move. So the government of Japan, and governments, probably central banks around the world coordinating with them, have decided to make this massive move and devalue the yen and against almost all the major currencies. And what's it going to result in? Probably nothing but disaster, because that's what government intervention in markets always results in, is disaster. And that's going to be the main story of the night. But before we get over to that, I wanted you to look at this story that's over on Zero Hedge, and this is an absolutely fascinating story here, because this is China reporting their gold imports. And let me read this to you. Back in December, as always happens every year for the past three, a margin call driven liquidation wave pushed the price of gold to multi-month lows, providing merely yet another lowball buying opportunity, for which let's all thank John Paulson again, one buyer who certainly would love to thank whichever magical seller was liquidating their gold is none other than China, which was reported a few hours ago to have imported an all-time record of 114 tons of gold in the month of December. So you can see that here in this chart. There's your 114. This is your monthly totals going back to, yes, that's correct, January of 2012. Now, what do you get when you add this number series together? You get 830 tons, metric tons. So now I don't have time to read this whole thing, but what is fascinating about that is you look at that figure and then you compare that to this total. This is official gold holdings. So China is reporting, this is what they reportedly have, is 1,000 tons basically. But we see that in 1 year's time they imported 830. So we're to believe that China imported basically their entire gold reserves in 1 year. So we know that's not true. We know that China, Tyler Durden speculates that they probably have 4 to 5 times that. I'm speculating they probably have 8 to 10 times that. And of course, we have the leader here is the United States, and they are reporting that there's 8,000 tons. Second up, of course, is Germany, and then the IMF. So if this number here for China is false on the low side, is this number up here false on the high side? I think you probably know the answer to that question. Now, the other thing that is absolutely fascinating here, I want you to look at, is this percentage column of reserves. Now this column is telling you how much of their reserves that gold represents. So with this reported figure, they're telling us that China's 1,000 tons of gold, it really only represents 2% of their reserves. They're also telling us that the U.S.'s 8,000 tons represents 76%. So let's say that China is actually where I guess they're at. Let's just multiply this times 10 and say that they have 10,000 tons of gold. And of course, that's going to put them in number one. And of course, this figure, you probably, for the United States, you need to cut that by tenfold, so that's probably way down here on the list. But even at that number, you can see you would multiply this number by 10, and you can see that even if you multiplied the reserve percentages by 10, you would have China having 10,000 tons of gold, and that only representing 17% of their reserves. So it's pretty clear from these figures who is winning the war, and it certainly isn't us. So that's what you get when you have governments intervening in markets. Now, the markets that are being intervened in this case are the gold markets, and the result of that is that the gold is flowing to the east very, very rapidly. And as Tyler speculates here, and I think he points out that he made that call back in 2011, that China is going to float their currency backed by gold. And all this with inflation in China is supposedly tame. Just wait until the trillions in new money created in 2013 finally find their way to the Chinese market and send inflation through the roof, as happened in early mid 2011. And that when gold exploded. Once the increasingly more affluent Chinese middle class decides once again to lock up its wealth in the form of gold, then and only then will gold finally cross the so far insurmountable $2,000 resistance level. Maybe he's right, maybe he's not, but that is an absolutely shocking number, that in just the course of 1 year, China has pretty much brought in from Hong Kong the entire amount that is supposedly their reserves. So that just speaks for itself. Now let's get over to the main story of the night, and that's going to be about markets. And if you remember last night, we talked about Cristina Fernandez and the manipulation in Argentina, the attempt to control markets. Of course, you can never control markets, and so I wanted to go to the story of the Hurricane Sandy and the gas price rationing that happened there. There's a fascinating article on Laissez-Faire Bookstore about that. But before I go there, I want to look at the a video that was linked on one of the Zero Hedge readers linked it, and I want to cover that video about why government price controls always fail. And of course, this is our modern day King Canute here. Here's Chris Christie on the cover of Time magazine, and apparently he's the hero of Hurricane Sandy. Of course, nothing could be further from the truth, and I think you can kind of see the arrogance there. But what's fascinating about King Canute, you've heard the historical tale that Canute commanded the waves, but it's actually not the case. History has it completely wrong, which is typical of history, that it's completely the opposite. King Canute wasn't arrogant. He was the exact opposite. So let's read this summary here. Henry of Huntingdon, the 12th century chronicler, tells how Canute set his throne by the seashore and commanded the tide to halt and not wet his feet and robes. Yet continuing to rise as usual, the tide dashed over his feet and legs without respect to his royal person. Then the king leapt backward, saying, "Let all men know how empty and worthless is the power of kings. For there is none worthy of the name, but whom heaven, earth, and sea obey by eternal laws." He then hung his gold crown on a crucifix and never wore it again, to the honor of God, the Almighty King. This incident is usually misinterpreted by popular commentators and politicians, and is as an example of Canute's arrogance. And we can see here it was exactly the opposite. Canute realized by commanding the tide that it didn't obey him, that he really didn't have that much power. And that's what we find with markets. The King Canutes, the opposite of the Canutes, but the the proud and arrogant politicians of our day think that they can command market prices to obey them. And we're going to see how that story unfolds with the gas price story. I want to look at that. But before we do, I want to give you kind of a primer on economics. And this is one that was linked on Zero Hedge, and I think it pretty much is self-explanatory. So I'm going to play most of it here because it's a lesson that probably every PhD in economics in all of the Keynesian schools need to listen to, because in 4 minutes you can know more about economics than every PhD that you've ever met.
Hi.
So David, what is government price fixing?
Well, government price fixing refers to government setting the price of a good or service rather than buyers and sellers negotiating one. For example, politicians may determine in some circumstances that the price of a loaf of bread should not exceed $1. Other times, governments try to keep prices up. And a really common example of that is the minimum wage, where they determine that the wages for an hour's work can't fall below, say, $10.
What is the rationale behind government fixing prices?
Well, the usual argument is that it protects the vulnerable. Politicians may reason that the price of bread is too high and people with limited means can't afford it, so they artificially lower the price. Likewise, the government may think a wage of less than $10 an hour is too low and sets the price of labor at $10 per hour or more.
Surely this is a reasonable goal. What's wrong with making prices fairer?
Well, it sure sounds reasonable, but as with all policies, we need to look at the long-term effects on all people rather than just the short-term effects on some. So let's first look at, say, fixing a maximum price. When the price of bread is set too low, the baker will bake less bread. With bakers supplying fewer loaves of bread than before, there's going to be a shortage of bread. But it's worse than that because at that low price, people will demand more. So you create this gap between the quantity supplied and the quantity demanded. So there's cheap bread available, but not everyone can actually get it.
So government price fixing has many drawbacks when keeping prices low, but isn't a minimum wage a different issue?
Well, not if you see wages as being also a price. So when you buy bread, you're not just buying ingredients and so on, you're also buying some baker's time. And when the price of bread is lowered, it creates a bread shortage. Raising the price for a baker's time makes that problem worse.
Okay, at some point you end up with a situation where the legal price of a loaf of bread is less than the legal price of paying a baker to make it.
Well, yeah, if you have both of those policies at the same time, it does get messy. If you take them in isolation, though, the important lesson is that wages and prices can't just be wished up and down, because doing so changes the quantities of the good that people are willing to supply. Ultimately, you get less of what you were trying to get more of, and you undermine the whole purpose of price fixing in the first place.
But the original purpose of lowering the price was to ensure that everyone could afford some of the good or service. If we accept that price controls will change the amount of goods or services available, what about introducing rationing to make sure everyone gets a fair amount?
Well, when you think about it, rationing is really just another monetary system. So there's still a price, but it's paid in coupons or tickets as well as in money. So this can reduce the demand, but ration tickets in themselves are not valuable. So they don't reward people for increasing the supply of goods. The shortage problem is not actually solved, and the situation becomes more complicated by having two monetary systems, one in traditional currency and another in ration coupons.
If the challenge is to increase supply, surely the baker could supply more if his costs were also reduced. Why not reduce the cost of flour and baking equipment? The baker could then produce more at the controlled price.
Well, there is a certain symmetry to that until you look beyond the baker. Now, his suppliers can't cover their costs, so the same problem grows out in ever-widening circles. Not only are customers lining up for bread, but the baker's not even there because he's somewhere lining up for wheat and yeast.
If reducing the baker's income creates all these problems, surely this can be solved by subsidizing the baker's income.
Well, unfortunately, that doesn't solve the underlying problem. The result is that the baker now sells as much as he would have if he were charging $1, and he gets another dollar of subsidy from the taxpayer. That's a good deal for bakers, but it doesn't help people with low incomes because the wealthy can afford to capture more of this subsidy by buying more of the subsidized loaves. All this money from the taxpayer has to come from somewhere, and that means less of other things are produced by government.
So when politicians fix price, it has the opposite effect to what they intended.
Yeah, prices are not a problem in themselves. They reflect powerful economic forces. And fixing prices is like jamming a thermometer or a thermostat. It might make you feel better, but it won't get you warmer. The real problems get worse and go unnoticed due to government price fixing.
So there you have it. That's a very simple summary, one that probably any 10 to 15-year-old can understand, but apparently our politicians are unable to understand that. So let's get over to the gas price story. This is from Jeffrey Tucker. This is fascinating because this is a story from on the ground of what actually happened in the Hurricane Sandy situation with the gas. And you'll see here when we flesh this out that it was actually the free market that saved the day. And of course, if they would have just left it alone, the whole thing would have worked out. But of course, politicians have to get involved and gum things up. So let's read this here. For those schooled in economics, the gasoline shortage during Hurricane Sandy last November was no surprise. Demand for gas goes up. Supply lines are disrupted. It's the old supply and demand thing. The price goes up. Higher prices attract new supplies from unconventional paths. Prices respond and fall back again. The market handles it just fine. All is well except for one thing. There were anti-gouging laws on the books. These laws restrict the upward path of prices. Plus, most people anticipated exactly what happened. By executive order, governments at all levels impose even more restrictive controls. These controls prevented prices from being illicitly raised at the onset of the crisis. Most of us got our news during this time from conventional outlets. We lived on scraps of information. Most reporters, as you probably know, are not schooled in economics. They don't know what to look for. They see a gas line and don't know what to make of it. The whole problem just mystifies them. They don't get how cause and effect work in the economic realm. That's why those of us on the outset had to make do with such scattered reporting. What about people on the ground? There was one trader in New Jersey schooled in economics who knew exactly what to look for. He understands cause and effect. He knew that shortages were coming, and he knew the market wouldn't give a flying flip about the government's orders not to raise prices. His name is Peter Earle. He did a real-time reporting during the entire episode. His report begins 3 days after the storm hit. He was on the ground watching pump prices. He saw black markets working. He was downloading smartphone applications that were quoting real trades. He spent his evening hours on websites where there were bid-ask quotes going on constantly. He subscribed to every gas tweet, of which there were many thousands. What he found was extremely revealing. Despite laws and warnings, threats and denunciations, the market did indeed work as expected. The action began on November 3rd. Prices shot up from $5 to $10 to $15 a gallon. Diesel was selling for $35. Generators were also all over the market, rising in price. The markets became very sophisticated very fast. People were including delivery in their price at premiums. Within hours, the terms became more complex, varying by quantity purchased and service provided. One seller offered the following terms: 10 gallons cost $150, 20 gallons $200, 30 gallons $250. Another offered 50 gallons for no less than $7 per gallon. Still another offered $12.50, but with a 5-gallon minimum. Earle calls the sellers of gasoline and other essentials disasterpreneurs, business people who know how to make a buck while providing the services people need. We think of black markets as consisting of sketchy people selling to sketchy people, but this was not the case. Absolutely the whole population was involved. Already on this day, the economically illiterate were denouncing what was going on. Earle quotes one tweet, quote, "Instead of trying to screw people, you should be someone who has no heat. Free gas." I won't say that. So, well, that misses the point. Gas will be rationed in good times and bad. It can be rationed through market prices that reflect real scarcities, or it can be rationed by executive edict, as was eventually the case in New Jersey. All throughout this day, prices were both up and down. The highest price Earle found was from devastated Staten Island. It was for 5 gallons for $25 per gallon. But not even an hour later, he found a new low offer that fell to $8 per gallon. Interestingly, not all bids were for money. Earle found some evidence that some unnamed illegal services were being offered for gasoline. Also, the following morning, a trade in New York sought to buy 5,000 gallons of gas for a baseline minimum of a $20 Gold Eagle. Interesting, isn't it? Most people don't keep much cash on hand. In a crisis, they can't get to a cash machine. In a serious crisis, cash machines don't work, or maybe they're empty. What do? Gold and silver might be the only truly marketable commodities. The trading boards were also filling up with offers to bring gasoline in from Maryland, Ohio, and as far away as Georgia, all provided that market prices would prevail. After all, if there's surpluses in those states, why not truck it in, make some money, and do some good at the same time? Makes sense. Yet, as expected, it was just as these markets were driving down the price to a stable equilibrium that officials at all levels started to announce that they would soon begin prosecuting price gougers. That did it. Prices went up again to the $15 to $20 range. This was when things got pretty scary and the market players had to become a bit more careful, arranging deals in secret and exchanging goods rather furtively. So I'll let you read the rest of that. There's also a video interview with this gentleman, and that's fascinating, real world, on the street reality of black markets. Of course, black markets exist all around the world, and you're going to see more black markets when you see more government suppression of markets. That's just the way things go, and it doesn't matter how much the boss decides he doesn't like black markets. There are always going to be black markets, and I think that politicians of today probably could take a lesson from King Canute, who realized that he couldn't command the tide. There are certain things that were outside of his power. So we see now that in China, the importation of gold continues. China knows what free markets are. Much to everyone's chagrin, China and most of Asia is moving towards free market capitalism. So is Russia, as the trilateral powers of Europe, America, and Japan move further and further towards command economies, socialism, communism, and fascism. Of course, what that means is the free market is going to reward Asia, China specifically, and I agree with Tyler Durden. I think that ultimately China will be rewarded with the next world reserve currency, and the market manipulators in the West are going to find that their manipulations have failed. And we'll talk to you next time.